Hey guys, welcome back. In this video, we are talking about the liquidity drying up, the $800 billion collateral gone, the missing data, and many more in this video. First, we're taking a look at this. Bank usage of Fed's reverse repo down 75% from last week to 4.9 billion. The RRP usage is down from 2.55 trillion in 2022 to 4.9 billion today. Liquidity is drying up real fast. So one of the things we've been looking and focusing on has of course been the repo and the reverse repo. What it does is essentially shows us what's happening within the economy, how in need of liquidity are the banks, are the institutions, and when we see the reverse repo go to zero, what we also know is that these institutions won't have easy access to money anymore. They won't have easy access to capital, which stops them from creating the synthetics as much and as freely as they were able to do back in the days. And so as we're seeing this number closing down to zero, what we are going to be looking at is the difficulty for these short sellers, for the banks, for the institutions. Another thing that we use is obviously when we do see it spike up, every time we see the reverse repo go up in times like this, it's obviously showing that institutions are in need of injection. And typically when they are in need of money, it's because they have positions that are extremely risky. So we're approaching a situation where the demand for capital with these institutions are increasing. However, there just isn't that much supply to give to these institutions, and that's the problem they'll be facing. And that's what we've said with how AMC and GME short is obviously pressuring these institutions because it is eating into their capital. And so this is why we pay attention to the reverse repo. Another big thing is understanding that breaking Nvidia's losses accelerate to minus 5% on the day, now down 16% since Monday's high. That marks a drop of $800 billion since Monday. So the reason why I find this pretty significant is because we've known that companies like Nvidia and others as well, their stocks are used as collaterals for AMC, for GME. We've shown the correlation between such stocks and AMC, and we've shown that with crypto as well. What we've known is that one of the biggest reasons for why these short sellers had seemingly looked like they have an infinite access to capital and money and the infinite synthetics is because they use collaterals, they use stocks like Nvidia to get them collateral, to get them money. And when we've seen the fact that Nvidia is a $5 trillion company, what we are looking at is, of course, how that money is then used to then short AMC. But as we see Nvidia lose their value, as we see all of these other stocks lose their values as well, what we also are looking at is how the collateral value that these institutions once borrowed are also dropping as well. And so this is why we're met with AMC today down 7%, despite the fact we had great earnings for AMC. We've seen how the institutions, how the market was reacting to AMC. And as they see that the collaterals is failing even more, as they see that their money is losing even more, they then feel the need to suppress AMC. And this is what we're looking at with this, because when we take a look at AMC, there has been no bad news whatsoever that would have shown that AMC would drop 7%. We saw the reaction towards the earnings. We saw it up 4%. And so today was just a random day, and yet AMC dropped 7%. But is it really random? And this is why we said, when you look into exactly what's happening, when you look into the stocks that are used to short AMC, they are all losing value. They are all going down. Remember the pressure this is going to force towards these short sellers. Short sellers use their collaterals, use these stocks at the highest, at their peak value as collaterals. And now they're seeing these stock values go down, meaning that the money that they've borrowed are decreasing and they will have to pay it back. But the problem they face is that the stocks that they've used to short are not going down. And in this case, what we saw was the fact AMC was up 4% yesterday. And so in times like this, when you're seeing these stocks that you're trying to short go up in value, but yet your collateral is going down, you would then need to obviously manipulate and push the price down. And that's what we saw with AMC today. And you can mix it up. You can see how it mixes with Nvidia and all of these other assets that were once used as collaterals that have all dropped in value. Another big thing is, where's the FTD data for GME and AMC? The SEC uses it, drops it twice a month, but the October data is still missing. And the thing that's interesting about this was that this was right after GME gave out new warrants, the short volume exploded, millions sold that didn't even exist. And if you want to tap more into this, you can see October's FTD data didn't just go missing, it vanished right during a known liquidity inflection point. Dark pool volume held steady, repo usage dipped, and price action mirrored the suppression cycle, then boom, a 5-day gap in reporting. Convenient timing when synthetic positions need breathing room. And so we've seen this happen plenty of times in the past, where FTD data are not being released, and it's on the same day as when something is happening for this particular stock. We've seen it happen with AMC, we've seen it happen with GME, and we're seeing it happen once again. And so this is why we've said that the things that GME has done, the thing that AMC has done, it has all been correct. Every time we talked about how our companies are taking action and fighting against these institutions, it has been working. Evidently, we see it because these institutions would then feel a need to obviously try and find ways to stop that, whether it's to not report the FTD data, whether it's to hold a stock. These are all indications that what we've done are working. And so in this case, with everything we talked about, you can understand why the FTD data isn't being published. Another big thing is that as we're seeing, at the FTD data missing, we're also looking at this. XRT is nearly 1,000% short again and fails to deliver data has gone missing, probably nothing. So you can see how it just correlates with AMC, it correlates with GME. XRT, the stock, the ETF that's used to short AMC, to short GME, to short all of these plenty of other stocks, you can see a 905.85% percentage of shares short. This is already showing the synthetics that are out there, and this is synthetics of ETF, but more importantly, the shares, the individual shares, the individual stocks that are including within these ETFs, those are being rehypothecated and being created synthetics of. And so the fact we're seeing nearly 1,000%, you should already see how that is creating synthetics. The only reason why it's not talked about as much is because it's not directly saying it's AMC, it's not directly saying it's GME, it's because it's talking about a particular ETF. And the very fact we're not seeing the failures to deliver data should already show you why it should be something that there needs to be more focus on. And if you take a look at this as well, you can see, check out the churn on XRT shares outstanding. From 2 mil to 7 mil inside of 2 weeks, just to drop back down to 2 mil, then go back up to 7.8 mil inside of 2 weeks. And this is what you're looking at for the shares outstanding for XRT. And we're looking at this again. You can see why we are not seeing the FTD data, but you can also see how it's being used to locate and create synthetics of AMC, of GME, of all of these stocks that we've talked about. Again, XRT isn't the only ETF that is being used. There are other ETFs that are also used as well. But the very fact we're looking at this should already tell you what is actually going on, how much suppression is actually faced within the market. So you can see why we're talking about this. You can see why we've said that there is almost 1,000% short interest, why we're seeing these shares suddenly being created out of nowhere that are just going back up and forth. This is exactly things that apes have been pointing out for the last few years. These are the reason why we know we're not in a fair market and why we're faced with constant suppression and manipulation. Another big thing is that we have to understand, and this is talking about AMC, is that we obviously talked about the AMC earnings, and I didn't want to bore you guys with continuous videos about the AMC earnings. But one of the things that we're seeing people say is right now is that hosts are saying Cinemark has no debt are wrong. Cinemark still has 1.8 billion in long-term debt, but they did retire the last of their pandemic financing this quarter. And so you can see what we're looking at is how the firms do have debt as well. And so when you see these people talking about using debt as a reason for why AMC is a bad company, you need to then revisit this post again. But it's also about understanding how each firm is obviously approaching it. Like I've said, I don't think that Cinemark is a bad company. I think what they've done is, of course, very well. The only reason why we use Cinemark and AMC as a comparison and why we talk about the disparity in terms of their price movement on the exchange is because of the fact that we've seen that Cinemark has 120% institutional ownership, whereas for AMC, it has a 95% retail ownership. And so whilst there is nothing wrong with Cinemark, the company, when we take a look at what exactly going on is the comparison of a retail-owned company versus an institutional-owned company. And from there, we can really see the transparency between how they treat retail stocks versus how they treat institutional stocks, despite the fact how both are operating within a same industry with same similarities and only minor differences. Now, as always, this is financial advice, so do take it as a grain of salt. Make sure to do your own due diligence and research, and I'll catch you guys next time.